Vikash Kumar Jain, CLSA India, joining us this morning. Needs no introduction. Very good having you here, Vikash. How are you looking at, first off, the earnings for Q1 FY27? Has it surprised you on the upside? And would you say that Q2, Q3, the earnings momentum can sustain? Let's start with that.
Yeah, hi, thanks for having me.
Great having you.
On Q1, yes, there was definitely a surprise if you exclude energy, which was expected. In fact, one of the big surprises came from energy because initially our expectation was very large losses for oil marketing companies. The actual numbers were not as bad, but even if you exclude that sector, numbers were much better than estimate. It is actually the first time that PATX energy in about 8 quarters grew over 20% or so. So that was the good news over there. On your question of, does that mean that Q2, Q3, Q4 is looking good? See, what we need to appreciate is looking good on an absolute growth basis is not how the market looks at things, because surprisingly, despite such reasonably good numbers, if someone was to just look at the numbers, there were still downgrades to estimates. That's something which is the only thing that which is something which keeps happening regularly with most in India. So what has happened is our expectations are still pretty high, and that's what is coming down gradually. Thankfully, now we can break this expectation into cohorts, and we find that on the large cap side, expectations are far more benign. Expected earnings growth over the next 2 years is only about 11% or so, which is still more reachable. But on the small cap side, things look far more extreme. So when you say that Q2, Q3, Q4 would be good or not, I would say versus some of those elevated expectations, I am not so sure if they could beat those expectations. So good defined by beating expectations or meeting for particularly the small cap side of things. However, and in addition to that, the other challenge that I see is the uncertainty around the global macro setup, because many of these expectations and earnings estimates have been made with the hope of the Hormuz crisis ending sooner or later. Some might have baked in that, yes, maybe it ends in the first half, improves in the second half. But at this juncture, we can't really say anything which is definitive on when this crisis ends and when supply chains kind of normalize. So that uncertainty is the other thing which continues when we talk about earnings in general.
That uncertainty, and then there is flows as well, which is working against us, right, Vikash? Which is one of the concerns. You know, the argument that DIIs can continue to support the market, and there's just so much fresh paper coming in, and despite that, we're seeing the market really supportive, and there is more anticipated as well, right? Some big IPOs anticipated later this year as well, which will likely come through. Do you believe DIIs can hold the market higher, just given the environment?
See, just by themselves, I think, so we look at DII buffers simply calculated by what we call dry powder, which is a combination of cash held by equity mutual funds plus unallocated equity portion of the hybrid funds. Both of those put together is somewhere around 7.2% or so for at the end of July. Now that number is a multi-year low. Essentially, if you look at that chart and the way that line moves, through the period of this 25, large part of 25 and 26 initially, the foreign selling that we saw, a lot of that got absorbed by DIIs using their buffers. What that number, where it currently stands, what that tells us is their ability to keep fighting another significant bout of foreign selling is now very limited. So for the market to do anything significantly good, we will need foreigners to come and start participating. The other challenge that some of these buffers will have is they will go on to kind of digest primary offerings which will be there. The IPOs that you talked about, many of them might be coming in the next couple of months, some large ones. If that is the case, then that is where this buffer might also be utilized. When you look all of that, and if you cannot really be sure of foreign money coming into the market, then very little might be left into what goes into the secondary market. And what goes into secondary market is what will take up Nifty or NSE 500, and that is the bit. The flow picture is not that clear. So simply put, for us to get any reasonable upside on the market, we need FII participation to be back. And that's the big joker in the back at this juncture.
But you're very well placed to address that joker, Vikash. So do you expect that to come back? Do you expect the FIIs to reverse? And just given the fact that the US 10-year bond yield is at 4.7 and expectations just continue to be that rates will go higher. You obviously have the Fed chair speaking at Jackson Hole later this week. How are you looking at the FII picture?
Yeah, I mean, let's be careful of what we wish for, because, if we look at the 10-year at 4.7, or if you look at the US 10-year, US 30-year at 5.3, see, we are at a very important situation, which could end up being, something that could be a multi-decadal move on the macro side of things. See, here you have the US Treasury and trying to support the yields. They have made two measures. One is around the yen, the other one is just around, the longer dated bonds. But despite all of that, yields have not really cooled off yet. Now this is a binary situation. Either they win this battle and yields cool off. If that happens, then, we might actually end up seeing a more broader rally. But in that broader rally, will India lead that rally is a different discussion. But if that does not happen, then that's where I think there could be wider nervousness across financial markets. And that's something that we need to be very careful about. If it does not happen, if say the 30-year goes up beyond 5.35, it was around that 5.3 mark, it's right down 7-8 basis points in the time when the last action by the Treasury was taken. And even the yen, it is not that it has appreciated significantly after that initial announcement. So whether we are able to keep it, whether we are able to keep it under check or not might determine global macro on a slightly longer term and a medium term perspective. So, but on the other hand, what might happen is if we have a bigger global nervousness, here is India, which is corrected quite a lot. And it might outperform in that nervousness, it might outperform by falling less. That does not take prices higher. In fact, if you look at the last 3 or 4 years, barring 1 year, which was the election year, India has beaten global benchmarks by doing very little, because that was a time when global benchmarks were correcting or kind of quite nervous. So given that we had a very big valuation re-rating in 2021, we've actually not beaten that kind of PE multiple numbers at all. We have gradually come off. We are now coming off to what is getting closer to fair valuation levels. So from that perspective, you can say that the risks of big downside is much lesser in India as compared to many other hot markets. But for big upsides, for us to go back to our bull case kind of valuation, and in the bull case, we could see, say from here till March, about 20-25% upside in the market. For that to happen, we need to have large FII participation coming back. And so far, we don't have very clear hints of that happening in a big way.
If FIIs were to come back, Vikash, and I'm going to switch the conversation now to sectors, right? Would it come back straight to the traditional ones, or has the world changed since the last time they really allocated? And will it be real economy sectors, banking, IT, and the like, or will it go to some of the smaller names?
See, yes and no, because there could be some set of traditional sectors which might be looking good. For example, private banks. Now, this is the interesting thing, because we do a very detailed look at domestic mutual fund offerings. We have this proprietary product called Portfolio Pulse, where we look at 700 plus active mutual fund portfolios, which equate to almost about $500 billion of active money. What we find over there is within financials, domestic mutual funds have very unequivocally moved towards private banks. Everything in financials other than private banks, whether it is PSU banks, whether it is lending non-banks, or it is insurance, or it is capital markets, they are quite low on their active weight versus where they've been in the last 3 years. But private banks is where they have put in a lot of active weight. So in terms of the domestic side of the move that has happened, but still private banks have been okay performers, but not really the way one would expect them to be, despite the fact that they are also very attractively priced on a valuation basis. So I would say that that could be the first place where foreign money will come into. Beyond that, of course, we have now some bit of new economy kind of sectors to also offer. So there could be a mix and match of some traditional sectors and some new economy sectors. If you look at something like IT, I don't think it's traditional anymore. It's right at the center of the global debate. I have my doubts if it's a sector where foreign money will come looking to invest, because they have ways to play what IT services in India offer, even in other markets. And some of those comparable stocks are even cheaper than IT services stocks in India. I think IT services in India has now moved to more like dividend plays, and it's more plays for domestic money rather than foreign money at all. So I would say private banks, yes. Then there could be a mix and match of some new sectors.
But then I'll come to private banks in a bit, but very interesting view on IT, right? Let me try to get that. You're trying to give us a sense that IT probably is just a domestic play, and therefore the upsides from a stock price perspective may be capped.
See, I would say that domestic play, as in the incremental buyers will be domestic money. I do not mean domestic players in them getting business from domestic side of things. And so essentially, they in my way, I would think of IT to be compared cross sectors of something which is stable. What is the right multiple they need to trade at, and when stable and dividend yielding? So that's how domestic money will look at things. But when it comes to foreign money, they have various ways of playing tech globally. IT services would be right down their thought process in their order of priority. So I don't expect them to get excited about Indian IT services so soon, unless, our longer term view remains that over a slightly longer term, there will be IT services will gain, because we don't expect AI to be something which is just plug and play. Corporates will need help to roll out AI and benefit from AI. And that's where IT services companies will come in. But, for the full benefit of that to show up in numbers, it will take some time. So over the longer term, yes, they might come back, but immediately, I really doubt that is going to be the case. Unless, of course, if we have, if there is a kind of a burst around the global AI bubble, if there is one like that, then this is an anti-AI trade, where people might come and play that. But again, that's in the category of be careful of what you wish for.
No, point taken. Vikash, the other one was private sector banks, right? And you were one of the early callers on one of the largest private sector banks. I think 2025 is when you said, you pulled it out of your portfolio, of your model portfolio, and you replaced it with two others, maybe a few months thereafter. Give us a sense now, what should the tilt be with regard to private sector banks? Should be the larger ones, should be the smaller ones? Is it stock specific or is it secular?
Yeah, so I think this is where, if you think of the macro, if we are in a situation of commodity prices staying high and yields staying high, then one of the reasons why people were not so sure on private banks was the whole NIM contraction when rates were being cut. I think that's now behind us. With that being behind us and higher commodity prices leading to higher credit growth, I would say larger private banks, some of them appear pretty attractively priced, should be the ones to focus on. Selectively, one could look at the smaller ones also, but I would say at this juncture, when one is not so confident of seeing big beta in the market and the larger ones are cheap, that could be the first call for most investors when they go. Some of them are very attractively priced. So I would say, if you want to take a slightly longer term horizon, definitely they look very attractive. In the immediate term as well, I think the setup is very good, because the NIM contraction part is now behind us. for most likelihood, it appears that the next move will be higher for rates, may not be immediate, but in general. And, like we discussed, US yields are looking very stubborn and not really looking to come back down anytime soon. So all of that typically works well for private banks. In addition to that, if there is this other part that suddenly we might get into a little bit of a risk off, then I'm not really seeing that right now. Then some people might get worried about balance sheets, etc. That's where also the larger ones look much better. So I would prefer the larger private banks.
Vikash, any other sectors, pockets that you're liking at this point in time where risk reward looks better?
Yeah, so we like commodities in general because I'm somehow not able to wrap my head around how this Hormuz situation resolves itself before elections in the US. I think I was just reminded by some 10 weeks before we have US elections. If it is not resolving now, then it may not resolve before elections. If it doesn't resolve before elections, that's a very long time, and that might keep commodity prices much higher. So I would say commodities, private banks, and selectively some consumption players which are not that directly impacted or have been able to manage the commodity price risk because they need only some relatively less amount of price hikes for that. I think that's really our focus area right now. Selective consumption bets, commodities, and financials in general, particularly banks.
Curious, you mentioned that. Let me take it a little more specific. Auto impacted by commodities, and the numbers have been very, very resilient. How do you play that?
Yeah, that's where one needs to be very selective. I think the names that we have in our portfolio are the ones where we feel quite comfortable with risk reward because they are pretty attractively priced, and that's why and they appear like multi-year plays. But I think this is the bit where if you look at the last month, July, autos was the number one sector with domestic mutual funds was buying. Now in a setup where if the Hormuz crisis doesn't really get settled anytime soon, and we see another leg of spike up in commodity prices, then that's where there could be some nervousness in that sector. So I would say that I will be careful. I do have a couple of names, but these are, I would say, great risk reward trades that we have put in slightly more bottom up calls. But from a top down perspective, I'd prefer the ones which gain from higher commodity prices rather than the ones which get impacted.
Vikash, the other thing that you suggested that this could well be something which will be more prolonged, right? In terms of the West Asia crisis, what does that do to oil? Because to a large extent, there's been an insulation that has been given by strategic petroleum reserves world over, right? What are you building in terms of the oil prices?
I have to say that I'm quite nervous about oil prices. I think that they have all reasons to settle much higher than where they are today. I believe the market is quite colored by what it has seen over the last 3-4 months. That is a lot of release of strategic reserves, lower imports from many big buyers. And it is just extrapolating that situation to continue. But there is a practical limitation of how much one could eat out of reserves and till what time they feel comfortable. That's number one. Number two, at the same point of time, is the fact that there was this nervousness amongst traders, and that's why paper markets were not wanting to play that speculative trade. That one tweet, one announcement here and there, and then risk management goes for a toss. The commodity used to react 5-10% here and there. Now the challenge with now there could be a realization that the ability of the US administration to bring down prices quickly is getting challenged because I think now one announcement will not make people believe that that quickly that US Iran are settling things immediately. If that is something which dawns upon and that's a confidence that traders get, then there could be that speculative buying which comes in. Essentially, the way the commodity was moving, which was having multiple days of 10% moves, that's very difficult to trade. So the paper market was not getting involved in the commodity at all. So those were the two reasons why crude hasn't really gone up as much as it should have. But I think both of those reasons get tested if this crisis is not ending for another 2-3 months at least. Then I think I will be quite nervous. So that's another nervousness that I have on India.
Okay, Vikash, thank you so much. You've given us your time generously and your views as well. Thanks so much for coming in and giving us your perspective.
Thanks for having me.